everyone! Welcome back to the show. Today we're talking about a huge business collapse. It's a story that shocked China recently. Another major private company has fallen down hard. Suning, once a retail giant, is bankrupt now. They're going through restructuring with massive debts. We're talking about 200 billion yuan in debt. That's roughly 28 billion US dollars total. It's an absolutely staggering amount of money. But this story is bigger than one company. Some say Suning's fate shows the future here. The future of all private enterprises in China. Is that true? Is this a warning sign? What happened to Suning exactly anyway? Today we explore all these important questions carefully. So grab your drink and get comfortable now. This is going to be deep and important. Let's understand what's really happening in business. Let's start with how Suning became successful originally. Founded in 1990 by Zhang Jindong in Nanjing. It started as a small air conditioner shop. Through the 1990s and 2000s, Suning grew rapidly. They expanded across China, opening stores everywhere constantly. They became one of China's largest electronics retailers. Suning competed directly with Gome and other retailers. They offered good prices and decent customer service. Chinese consumers trusted the Suning brand completely. By 2010, Suning was a household name nationwide. They had over 1,600 stores across the country. Annual revenue reached hundreds of billions of yuan. Zhang Jindong became one of China's richest men. He was celebrated as a successful entrepreneur always. A private business success story for everyone. Suning even bought an Italian football club later. Inter Milan became theirs in 2016 purchase. They were spending big on international prestige. Everything seemed perfect for this retail giant then. Growth was strong, profits were good, future looked bright. But problems were building underneath the surface. Suning's problem started with aggressive expansion plans, really. They wanted to compete with Alibaba and JD.com. Traditional retail was moving online rapidly everywhere. So Suning invested heavily in e-commerce platforms quickly. They bought companies and built infrastructure fast. Billions of yuan went into digital transformation. They also diversified into many different businesses randomly. Real estate, finance, entertainment, sports management, everything imaginable. They wanted to be everywhere at once. This expansion required enormous amounts of money constantly. They borrowed heavily from banks and other lenders. Debt started piling up year after year. The problem was revenue couldn't keep pace always. Online competition was fierce with Alibaba and JD. Suning couldn't match their technology and efficiency. Physical stores were losing money as shopping moved online. But closing stores meant admitting failure and losses. So they kept unprofitable stores open longer. Meanwhile, all those side businesses weren't profitable either. Real estate wasn't generating expected returns at all. The football club was just burning money. By 2020, Suning's debt situation was critical. They owed 200 billion yuan to various creditors. Banks, suppliers, bondholders, everyone wanted their money. Cash flow became a serious problem for operations. They couldn't pay suppliers on time any more regularly. Store shelves started looking empty in places. Employee salaries were delayed, sometimes too, unfortunately. Workers worried about their jobs and paychecks. Morale inside the company dropped significantly low. Suning tried to sell assets to raise cash. They sold stakes in their football club first. They tried selling real estate and other properties. But selling in distress means bad prices always. They couldn't get good value for their assets. The debt problem was just too massive. Creditors started losing patience with Suning's situation completely. Some filed lawsuits to recover their money back. Legal pressure mounted from every direction possible. The company was drowning and couldn't swim anymore. Bankruptcy restructuring became the only option left. In 2021, they officially entered restructuring proceedings. Bankruptcy restructuring in China is a complex process. Courts oversee how debts get handled and restructured. Creditors must accept losses on their loans. For Suning, this means reorganizing the entire business. Closing unprofitable stores and selling off assets. Focusing on core businesses that might survive. The 200 billion debt will be restructured completely. Some creditors will lose most of their money. Banks might recover only partial amounts eventually. Employees face uncertain futures in this process too. Many will lose their jobs as stores close. Those remaining will see changes in management. Shareholders, including Zhang Jindong, lose almost everything here. Their equity becomes essentially worthless in restructuring now. Decades of building wealth disappear quickly like smoke. Zhang himself lost control of the company completely. New management appointed by creditors runs things. His empire is gone, his legacy tarnished. Suppliers who provided goods on credit suffer losses. Many small businesses depended on Suning's payments. Some might go bankrupt themselves from this. So what really caused Suning's collapse exactly here? Was it just bad management and poor decisions? Or something deeper in the system? Partly, yes, management made serious mistakes repeatedly over time. Expanding too fast, borrowing too much money. Entering businesses they didn't understand well enough. But there's a bigger systemic issue at play. Private enterprises in China face unique challenges. Challenges that state-owned enterprises don't face equally. Access to credit isn't equal for everyone there. State-owned companies get better loan terms always. Banks prefer lending to government-backed businesses naturally. When economy slows down, private companies suffer first. Government support goes to state enterprises first. Private businesses must survive on their own. Regulatory environment can change suddenly and unpredictably there. New rules can hurt private businesses overnight. Less warning, less preparation time given. Competition from state-backed companies is often unfair. They have deeper pockets and political connections. Private companies can't compete on equal footing. Suning isn't alone in facing these problems recently. Many major private enterprises have collapsed or struggled. This is becoming a worrying pattern now. Real estate giants like Evergrande also collapsed earlier. Tech companies faced regulatory crackdowns that hurt them. Private education companies were basically destroyed by policy. Each case has specific reasons and circumstances, obviously. But the pattern shows something systemic happening. Private enterprise is under pressure in China. Some analysts say the government prefers control now. State-owned enterprises are easier to control politically. Private companies are more independent and unpredictable. During economic difficulties, the state protects its own. Private enterprises are expendable if necessary for stability. That's a harsh reality for entrepreneurs there. This creates huge uncertainty for private business owners. Will their success last or disappear suddenly? Can they trust the environment they operate in? Foreign investors are watching this pattern very carefully. It affects their confidence in China's market completely. Capital might flow elsewhere for safety and predictability. So is Suning's fate really China's private enterprise future? That's the scary question many people ask. The answer is complicated and uncertain, honestly. If current patterns continue, more collapses will happen. Private enterprises will struggle to compete and survive. Entrepreneurship becomes riskier and less attractive overall. This could hurt China's economic dynamism significantly over time. Private sector drives innovation and efficiency usually. Losing that would slow growth and development. Young people might choose safer careers instead. Why start a business when success is uncertain? Why take risks when the system favors others? But China also needs private enterprise to succeed. The economy can't run on state companies alone. They need entrepreneurship for jobs and growth. So there might be policy adjustments coming eventually to support private business more and restore confidence. The government knows this is a problem. But trust, once broken, is hard to rebuild. Entrepreneurs who lost everything won't forget that. New entrepreneurs will be more cautious and hesitant. What can we learn from Suning's collapse story? First, don't expand faster than you can manage. Growth must be sustainable and profitable always. Second, debt is dangerous when used too aggressively. Borrowing for expansion assumes everything goes well. But problems happen, markets change, plans fail. Third, diversification isn't always smart strategy really here. Focus on what you do well instead. Don't spread yourself too thin across many businesses. Fourth, understand the environment you operate in completely. In China, private enterprises face unique systemic risks. Plan accordingly and stay cautious with commitments. Fifth, political and regulatory risks are real always. They can destroy businesses overnight without warning. No amount of success guarantees future safety. So Suning's story is a cautionary tale. A giant retailer brought down by debt. 200 billion yuan gone, thousands of jobs lost. But it's more than just one company's failure. It represents challenges facing all private enterprises there. The environment has changed, risks have increased. Whether this is truly the future remains uncertain. Much depends on government policies going forward. Will they support private business or not? For now, entrepreneurs must be more careful. The golden age of rapid private enterprise growth. That era might be over for now. Thanks for listening to this important business story. It affects millions of people and China's economy. Understanding it helps us see the bigger picture. Stay informed about these economic developments always, friends. They shape our world more than we realize. Until next time, take care everyone out there.